Welcome, everybody, to Public Live. We have with us today Dan Nathan, co-founder of Risk Reversal Media, to break down with us exactly what is going on in what seems to be a pretty exuberant market. Dan, thanks so much for joining us today.
Hey, Ann, it's my pleasure.
Well, it's great to have you back, Dan, because you're joining us right when we're seeing some new records being set. We've seen last week mark the 14th weekly jump in the last 15 weeks, something investors have not seen in over 50 years. We're seeing market concentration at its highest levels since the 1970s, with just 7 stocks accounting for almost 30% of the S&P 500 market cap. So what's going on here? Are we in bubble territory? Let's just cut to the chase. Where are you on
Well,
this?
I think part of what you're alluding to, Ann, is the fact that the concentration keeps getting more acute in the market. So these top, let's call them 10 stocks, are accounting for more and more of the performance of the broader market, and that's something that I think investors who've been in around for a long time, that's also been a signal of past tops or so. So here we are, we're a nice round number in the S&P 500 at 5,000. We're up about 22% from the late October lows. And what's interesting to me is that, in late October, I think a lot of investors started pricing in the fact that the Federal Reserve was going to start cutting interest rates by now.
Yeah.
And the fact that they've signaled that they are not going to be doing that at their next meeting in March, yet the stock market keeps moving higher. What was it, 15 weeks? You said it's the longest ever sort of thing. It just seems like, some of the narratives that were causing the surge in stocks off the lows in October, they've gone away, but investors don't care. They're still there. And so, it just leads me to a point where I feel like that the more a few of these stocks continue to go higher, Nvidia is one of them. I'm sure we're going to talk about that. It's gained nearly $1 trillion in market cap in just the last 5 or 6 weeks or so. It's just like the ability of the rest of the market to kind of just be dragged up by a handful of names is starting to concern me a little bit. It's concerned me, to be frank, for quite a while. But this is something I think is going to kind of correct itself in the not so distant future.
Let's start with what we're actually hearing, because we're still in the throes of earnings season right now, Dan. And to your point, an imminent rate cut is not happening. Right. So what was priced in, it turns out the facts are proving out to not be where expectations were. So what are we hearing in earnings? Are we hearing fundamentals? Are we hearing outlooks? Are we hearing productivity gains that justify some of the gains that we thought would be attributable to rate changes?
Yeah, I mean, listen, I think overall Q4 earnings season was pretty decent. And I think that's the story of the bull market of 2023. The pessimism coming into 2023, was that this universal belief that we were going to have a recession and that stocks were discounting that, right? So we never had the recession. GDP came in about 3%, which was far greater than most people thought it would for 2023. And so here we are. We just finished 2023 earnings and they were much better than expected, right? They weren't particularly great. I'm not sure they justify an S&P that's trading at 24 times trailing sort of earnings. But if you think of markets as discounting mechanisms, I mean, and the lows in 2022, we're clearly discounting recession that never happened. So here we are coming into 2024, and the level of optimism is probably as high as the level of pessimism was, more than a year ago. And so I just don't obviously have a crystal ball. I don't know where things are going, but the longer we don't have that recession that everyone expected, the longer the Fed doesn't cut interest rates, at some point we will have stocks starting to discount, let's say, worse economic times. And I just don't know when that's going to happen, but I think it could be pretty soon. And I'll just point to one date in particular. If Nvidia, which has gained $900 billion in market cap this year already, and it's one of the last major companies in the S&P 500 not to report, it's going to do that next Wednesday. If there is just any sign, right, of deceleration of growth, relative to how much the stock has moved, that could take the entire semiconductor group down. It could take the entire tech sector down. And with it, I think the overall market, because again, these mega cap tech stocks are really doing all the heavy lifting in the S&P 500.
Well, to your point, that concentration, big tech is now about 30% of the S&P 500 by market cap. And we've seen Microsoft, Dan, set a record for US single company US market cap on Friday. Talk to us a little bit about something I know you've been you've been tracking this and you've been out there talking about it publicly. You've been consistently concerned about the lack of broadening of share price appreciation and the level of concentration that we've seen here. What do you think happens next? Let's say Nvidia doesn't break and delivers the kind of news, maybe not the ARM kind of news that sent that stock soaring, but just delivers on what it said it was going to do and hits its guidance. What do you think is going to be needed in terms of performance by non-tech sectors or the other companies in tech that aren't getting quite so much attention right now?
Yeah, well, and to your point about Microsoft, again, my view very simply is that they pulled forward a lot of excitement around their relationship with OpenAI and the products that they have been able to create. I don't know if you saw the Super Bowl and you saw that Copilot ad, and that's a big part of the integration of OpenAI technology across their Office 365. That's the sort of thing that's gotten people really excited about this story. That's one of the reasons why it trades 36 times this year's expected earnings and 31 times next year, which your earnings are only supposed to grow 15%. So a PE to growth, a PEG ratio of 2 for Microsoft is really high, right? So it's trading at levels we haven't seen in a long time. But if Microsoft's the sort of company that touches all different sorts of industries, right? And you could start to extrapolate that, what would those productivity gains mean in other industries that are using Microsoft's products? And that's one of the reasons that probably you're seeing an S&P 500, trading at 24 times trailing, 21 or so times forward, and this is per FactSet, which is far greater than the 10 and 5-year averages that we've seen. So I think the market in general is pricing in a lot of the enthusiasm about what AI might do for individual companies, what it might do for productivity gains and the economy and the like. So I'm a little worried. I think that the AI thing, it started in semis, it's worked its way through software. We're going to start hearing it a lot about other industries. But I think your question is also, where else can you go in the broad market? Where are there other mega trends? I mean, one of them that's been very clear over the last year or so has been these GLP-1, these obesity drugs. Eli Lilly and Novo Nordisk are I think $1.2 trillion in market cap combined. The stocks continue to make new highs. They look like, if you just took the names off of them and just looked at the charts, they look like, the chart of any of these, sort of AI related stories that have gained a lot of market cap in the last year or so. But to me, the valuations are getting rich there. The stories are getting well trafficked. There's a lot of competition. We know every major pharma company wants to do something in the space if they're not already. So those are the sorts of things I think investors, when they're thinking about, by the time you get to one of these megatrends, by the time these stocks have already doubled or tripled in many cases and are trading at valuations that would only make sense if these companies were to own those markets going forward, you're probably a little late to the game.
Let's talk about some companies that do own their markets, Dan, and where there may be a play for them to, by virtue of their scale, become the consolidator of data. One thesis I had was John Deere, for example, if you want to go into ag data, or to go into Medtronic or medical devices, if you want to go into healthcare data. How are you thinking about applying what could be this productivity surge from AI to some of the more traditional, what about in energy? What about in banks? What
Yeah.
about in manufacturing? How are you thinking about those sectors?
Well, I think a huge misnomer is that these companies in all these different industries have not been investing in these sorts of technologies, right?
Yeah.
And so
Yeah.
one of the biggest things, if you're a technology investor, you think about, upgrade cycles and innovation. And these companies have been investing in machine learning, which is the predecessor to AI for like, if not years, decades, right? And so now that there was just, it's just kind of funny that there was this commercialized product, which is Chat GPT, which was launched, in late 2022, which just the abilities that it had were so much better than its prior version. It just, everyone was looking for something really exciting, and it caused this huge arms race. And then, a lot of analysts and strategists and investors alike were projecting how this could change those sectors that you talked about. Banking, of course, it's going to have huge influence. Of course, it's going to have huge productivity implications across numbers of different industries. But how do you value those companies? I can go back to the late 90s, and I can remember when everyone was talking about what the internet was going to do as far as disruption in all these industries, or how companies or industries were going to harness this technology to make them that much better, that much more efficient, that much more profitable, and therefore they should be trading at higher multiples. Well, the problem is, it's just human psychology. all that enthusiasm gets pulled forward in the stock market, right? And so if you talk about a John Deere trades at 14 times earnings. They're expected to have a decline in earnings this year, and they're supposed to go basically maybe get flat next year in 2025. So it's trading again at 13. It's just a cheap company. It's always going to be cheap. If there's any huge productivity gains or some data advantage they're going to get or this and that, whatever, and it helps them cut costs by cutting jobs and this and whatever. So fine, maybe it trades at 15 times earnings. You know what I'm saying? Like it's never going to trade at 20 times. And so I think having a little sense of history is really important because we've seen this again. Old economy stocks, that's what they were called when the internet came about in the 90s. It was new economy and old economy, and they all went up together because they're all going to enjoy these transformative gains or whatever, and then they all went down together in the bear market that followed. So that's the one thing when I talk to investors who are really excited about these trades and these transitions, do your homework, figure out like what it makes sense, how these companies and these industries are going to be transformed, but understand it's going to take longer than you think. And therefore the stock market might not be the best mechanism in which to measure the progress.
So am I hearing you say, Dan, and I'm absolutely going to put words in your mouth so that you correct this and shoot it down. Is the market right now partying like it's 1999? Is that what's happening here? Oh, is this crazy, bubblicious, peaky activity? And are you short the market right now?
I am short the market, but I'm a trader and I'd like to be tactical, right? So I, like everybody else, I recommend this to everybody is like, listen, dollar cost average, be like slow and steady wins the race. If you're investing for the long term. No one can really time the market, but I grew up on a trading desk in the late 90s. That was my profession. Okay. And so I like to stare at my fact set machine all day long. I like watching every tick in different stocks and different instruments and see how they interrelate and try to play short-term moves and the like. And I can also move my feet very quickly. I also can use futures. I can use options, right? And I understand them. I've been trading them for a long time. Most investors don't have the time to do that. They have careers, right? And they're not staring at screens all day. And so they have to do practical things as it relates to thinking about how to risk manage a portfolio in uncertain times, that sort of thing. So listen, I am, because I think we're probably on the precipice of a move lower, not too different than what we saw in July of 2023. We had a 10% pullback off of highs, okay? And people were really excited about all the same stuff. It can happen again, okay? And that's how I'm positioning myself to be. But that doesn't mean if you're a long-term investor, you should not care so much about that. Every month when you have excess income that you have to invest, you just dollar cost average, whether the market's up or down. And that's the way you stay in the game. But if you think you have some unusual knowledge about an individual story, you've done a lot of work and you're feeling heavy conviction, that's when you look at, how to play a single stock story or something like that. Maybe you want to express it using options to find your risk. Maybe you want to use an ETF that diversifies the risk across a narrative within a sector or something like that. So there's lots of different ways you can express these views.
Well, thank you for keeping us honest there, Dan, because to your point, time in the market versus timing the market, the old adage, right, about investing for the long term versus trading, something that's really easy to forget when you're in the euphoria of the market that we've seen as a retail investor population. Just before we move on to some of the more macro, some of the strategies you touched on, there are just two names right now that seems to be getting a lot more attention and a lot more headline mind share than others. Those are Nvidia and those are ARM as part of this chip craze. I've got one person's view. I look at ARM, I see how that stock has popped post earnings. I look at a company that's got very low float, right? And it's got huge exposure to China. And it is not in the cutting edge of AI applications, unlike Nvidia, which is. So when you look at those two stocks and hearing that you're short on the market overall, when it comes to these two names in particular, that retail investors are getting super excited by, where are you on those?
Yeah, so let's talk about, and there are phenomenons right now, okay? And so ARM just joined the party. And to your point about the low float, so SoftBank owned this thing. They're taking it back public. In September, they sold 10% of the company at $51. The fact of the matter is, on the day after their earnings last week, the stock was nearly up $51. That's absolutely insane. The guidance did not justify it. Some of the things the company said about their ability to kind of play in the space while they don't have high-end graphics chips like an Nvidia, but they're talking about the amount of compute and where they play and why there's going to be more demand for that. Fine, I get it. Maybe take the stock up 10, 20%. But what's happened over the last few trading days is absolutely absurd, in my opinion, especially when you consider their expected growth and the like. So there's a mania going on there. The fever will break soon, and it's likely to take down much of the space. There's also a fever going on in Nvidia. And the Nvidia story is really dangerous to me because the whole investment community has anointed them the winners of this AI and the TAM, the total addressable market that's going to exist for demand for these high-end graphics chips. I'm just going to say this, okay? In the last 5 years, Nvidia has been at the forefront of the crypto mining, of the gaming, of the data center, of AR and VR and the like, right? And so the stock, has outperformed when people are really excited about those things. They have a very promotional CEO. He is a rock star, to be very frank. The company is, it's a great company. They have great products. They have a great ecosystem. It's not just a semiconductor. There's a software ecosystem. They enjoy gross margins that are unheard of within the semiconductor space because of that. They own their market. They basically have a monopoly on it, but competition's coming. China, which has obviously been banned from buying certain one of their high-end graphic chips, were double and triple ordering for a while to get around those bans before they went in place and the like here. They've done a lot of vendor financing, so they basically invest in companies that will buy their chips, right? And then they use those chips as collateral. All the fishy stuff that we've seen in past cycles when technology is all the rage. We saw this Sun Microsystems at the turn of the century. At some point, it's all going to come undone. And that doesn't mean like it's a bad story or this or whatever. Investors are the ones doing this to themselves. The stock broke out at $500 in the first week of January, and it just traded as high this morning as $746. Well, you know where it is right now as we're talking? $715.
But price target's up to 800, by the way, including from the likes of Goldman Sachs, Dan.
Yeah, I mean, listen, because the analysts are sheep and they just chase the things up. I mean, they really do, and it's a hard job. And I don't mean that as a total derogatory sort of thing. But if you had when the stock was 500, if you had a $600 price target, it blows to your price targets through 700, and you're not justifying reasons why you can have a harder, higher price target, or you've had a hold rating on the stock since it was $400 the beginning of November. Mind you, it's early February right now and traded almost $800. That's you have the potential of losing your job, right? Of not being on the right side of some of these big trends. So they have a hard job. Okay. I'll just be really clear about that. So, to me, at some point, Nvidia, it's going to break. It's going to be back at $500. Maybe it comes from 1,000. I don't know. I don't have a crystal ball, but there's a mania going on right now. And the fact that market participants are not have their antennas up, they are not scared, Liz, that the stock has gained, $900 billion, and that's coming off now from the highs in 5 weeks or so, makes me very nervous about the potential downside of the broad market.
So the commodity markets and the bond markets, Dan, have been flashing slightly different signals from the equity markets. Are you looking at other asset classes where you see less of a disconnect between fundamentals and trading levels? Where are you putting your money to work?
Yeah, it's a good question. I think that the commodity space, specifically industrial commodities, has been really interesting. Since the pandemic, there's been all these different supply, chain disruptions, the war in Ukraine, since Russia's invasion in early 22, we know that, crude oil had that big spike and natural gas did, and it's since come off. And I think the bigger issue there is just the lack of demand from China. And we know that China weakness has been something that even both their economy and the stock market has been something that is probably weighing on global growth fairly dramatically, but it's nothing, it's been very well reflected in the price of crude oil. Right. And so, so I look at that. I look at the war in Gaza. I look at the disruption in the Red Sea, and I say to myself, I'm surprised crude oil is not up much higher. Right. And that really, I think, speaks to the lack of demand from China. China. And you could say, well, might China get much worse? Maybe. Might China get better and drag the whole world up with it? It could do that too. So I'm keeping a close eye there. I'm not really focused. I'll play crude, more technical right now because there don't seem to be too many great fundamental inputs. In the energy space, there's been tons of deals. One, today, this, Diamondback buying Endeavor for $26 billion. It's like the sixth huge energy deal that we've seen in the last 5 or 6 months or so. But the stock the stocks as a group, the XLE, the iShares integrated, energy select ETF can't get out of its own way, right? The OIH, which is the ETF that tracks the drillers, can't get out of its own way. So the energy space doesn't look particularly great to me right now. It would take a material breakout in the price of crude, I think, to get the stocks going.
While I've got you, Dan, as a last question for you, let's debate a little bit what is going on and play mind reader with the Fed. Because to your point, the market had been pricing in anticipated cuts of up to 6 potential cuts over the course of this year. That was on the very sort of aggressive end. Looks like it's definitely not happening before the late spring. There has been a little bit of murmuring, maybe it's just headline grabbing, that with inflation seeming to come down as quickly over the last couple of months as it has done, that the Fed should start cutting rates. So my question for you is the following. Why should the Fed start cutting rates if it's getting towards 2% inflation, its target, and you've still got a strong labor market? Why change anything?
Yeah, I agree with that. I think the worry that they have, and Fed Chair Powell said this a couple of weeks ago, at his presser and some of the commentary afterwards, is that they're not going to wait until inflation gets to their 2% target to start cutting interest rates. So I think that's something that is really important. But by the same token, they're really focused on this very strong labor market. They're very strong, focused on the fact that, financial conditions have eased with the stock market at all-time highs, with housing prices, still very high, right? With a large bunch, like a huge percentage, you probably have the data of, citizens who own homes in the US. Most of them, I think it's like 80% have mortgage rates that are below 4%, right? So the rise in interest rates has affected current homeowners. And then when you say to yourself, well, inflation has come down, so at least, gas at the pump and food is less than it was a year ago, it's still elevated, right? And so those are some of the things I think the Fed doesn't want to miss the inflation of inflation that they missed in 2021, right? So how high it got. But by the same token, they don't want to miss the fact that they basically got too easy in their monetary policy and allowed for inflation to get entrenched in the economy. Fed Chair Powell has been really clear about that. So I'm with you. I think I heard an opinion out of you that maybe the Fed should not be as aggressive as people who own risk assets want them to be, right? Like, remember Elon Musk whining all last year about interest rates and about what that meant for demand for his overly priced crappy cars and stuff like that. You know what I mean? So, and he keeps cutting prices, but it really isn't about the rate, because I don't think a buyer of a Tesla car is that sensitive, right, of maybe $100 difference a month or whatever, because interest rates have been higher to buy that car. So to me, I feel like the Fed, to really land the plane, they should probably not get too easy too soon. And they're also allowing for the fact, and this is a really important point, that if something does go wrong in the economy, in the global economy, and maybe there's some situation with a war, what is the Fed's playbook to do is to lower interest rates. So if they lower interest rates too quickly for not good reasons, then they really, run out of runway if something does happen that's kind of bad. So in some ways, they've normalized interest rates. It gives them a lot more optionality.
Keeping that tool in their back pocket. Dan Nathan, fantastic conversation, folks. Do check out Dan's content at RiskReversal Media. Fantastic podcast, very candid and direct, and prescriptive views on the market. It's hard to get those with people taking real stances. So thank you again, Dan. And that's it, folks. Join us all next time here on Public Live.